Great, great. Here we are. I will request Dr. Adam Mugume to come up as well. Dr. Adam Mugume is representing the governor, and he will be giving us the opening remarks. Today we will be discussing why lending rates are particularly high in Uganda. The governor usually says they are sticky and has an issue with commercial banks. And we will be hearing from the experts and also some of the policymakers later on in the day, and seeing whether we can really push this down. Recently, in Kenya, we had caps on interest rates, and there were all sorts of issues that came up with it. The private sector was squeezed out as the banks took their credit to the government securities. There's also a risk that some of the small banks could be stifled in doing their business. What's the case for Uganda? We will be hearing that. And without further ado, I will request Dr. Adam Mugume, the Executive Director, Research at the Bank of Uganda, representing the Governor, Professor Emmanuel Tumusime Mtebile, to come and give us the opening remarks for this policy seminar. Dr. Mugume.
Good morning, everybody. Distinguished guests, ladies and gentlemen, I'm here to represent the governor on this seminar, which is titled "Why Lending Rates Are High in Uganda." I'm very poor in reading speeches, so I will use my head if I'm allowed. First of all, I want to appreciate IGC for standing with us, to start with Bank of Uganda to undertake this study, but also to select one of the distinguished scholars, but also practitioners in terms of banking, the Jeffries, who will be presenting the paper. I think we shall see on some of the issues that are really causing lending interest rates to remain high in the case of Uganda. But to start the whole argument, let us first underscore that financial sector, whether in Uganda, whether in any other country, is very vital for development of the country. So there is no way you can have an economy that is developed when the financial sector is underdeveloped. Now, when you look at Uganda's history, some of us who were born yesterday, sometimes they don't remember where you came from. That by early 1990s, if you wanted to get a loan from a bank, you had to get a note from a minister of finance to take to either a cooperative bank or UCB to get a loan. So that's where you came from. So if you look at financial sector development indicators, for example, private sector credit to GDP, you see that Uganda has really performed well over the last 30 years. For instance, one of the indicators we use is private sector credit to GDP as a measure of financial sector development. You will see that, for example, in 1992, private sector credit as a share of GDP was only 4%. By 2018, we are talking about around 17%. So that is really a remarkable achievement in terms of that particular indicator. If you look at, say, non-performing loans as a share of the total loans, even as far as back as 1998, we are talking about 39%. Now, this one came down to around 5.2 on average in 1992, which is another remarkable achievement. Another indicator we normally talk about is bank asset as a share of GDP. You see that bank asset as a share of GDP moved from around 8% in mid-1990s. Now we are talking about 26% as of financial year 19/20. Another indicator we normally talk about is, for example, bank return to assets. This was minus in 1996. It was actually minus 6.2. In 1996, we are talking about on average in terms of around 3% in the last 5 years or so. So all indicators of financial sector development have really are pointing towards the financial sector development in the case of Uganda. However, one of the main indicators of financial sector development is the intermediation margin, the difference between lending and deposit rates. You will see that from the paper, this one has been on average around 15%. Now, 15% automatically means that is a sign of inefficiency or underdevelopment in the financial sector. So that is why this topic is very important. So it is important, therefore, to say, okay, all the other indicators seem to be good, but when it comes to lending interest rate vis-a-vis the deposit rate, then that's where Uganda scores poorly. So the seminar today, therefore, we want to distinguish, to break down that margin, the lending rate minus the deposit rate, and say, okay, what really contributes to this 15%, which is a sign of underdevelopment, when all the other indicators are showing that actually financial sector in the case of Uganda has been really moving remarkably well. So therefore, this seminar becomes vital in terms of trying to generate policy issues. Lucky enough, we have Minister of Finance here who will tell us, I know, is one of the problems, or no, not a problem actually, is one of the economic agents that is associated with that. We have Bank of Uganda. We shall see some of the issues to do with regulatory issues. What we call reserve requirement is part of and parcel of the problem. And the question therefore will be, what does Bank of Uganda do? What does Minister of Finance do? Another problem that we'll see later is the nature of the banking industry. That's why you have Wilbord here to help us. And also we have the borrower represented by Kasita. So I think these are good, so this is a good discussion. We have the policymakers, we have the banking industry representative, we have, I know Kasita normally calls himself a peasant, the person on the ground. How does he, the feel of this intermediation margin? So basically that is what the seminar is all about. Now, without wasting much of the time, therefore, I wish us success in this policy discussion. I hope that the discussion that will come from this seminar will inform policy going forward in terms of how best we can really mitigate some of these challenges we are seeing in terms of high lending interest rates. Without much of wasting time, therefore, do I have to say that I open this meeting? No. Okay. I have the honor on behalf of the governor to declare this seminar open. Thank you so much.
Thank you very much, Dr. Mugume. And in earnest, I'll call upon Dr. Twinemanzi, Tumuwende Twinemanzi. He is the Executive Director, Bank Supervision at the Bank of Uganda and definitely does the oversight on commercial banks. And if the governor decided to wield a stick, it will be through him. He will be our moderator. I will call upon you, Twine, to come and take over from here. Thank you.
Yes, good morning. It's an honor and a pleasure to be able to moderate this, this session. The subject that we're talking about today, like the representative of the governor said, is important. Not just to the business people, just the borrowers, but it tends to have an impact outside of those who actually borrow directly. In looking at this subject today, and the presentation we are going to have that's going to be made later on, is that the presentation is on interest spreads. And in Uganda, we have a unique situation where we have an issue with both the interest spreads and the level of, and the interest rates themselves. So today's discussion is going to largely focus on interest spreads. But I just want to be clear that interest rates also do matter. These are the high levels. And my job today is very simple. It is to ask the presenters to make the presenter to make his presentation, and ask the panel of eminent persons we have up here perhaps interpret or give us their viewpoint or perspective on what we shall be presented. So for the presentation today, on why interest spreads are very high in Uganda, it's going to be done by Dr. Keith Jeffries, a development macroeconomist and financial sector specialist, and who since June 2020 has been a senior policy advisor at the Ministry of Finance in Botswana. Prior to this, from 2005 to 2020, he was the managing director of Eco Consult Botswana, and he was also the former deputy governor of the Bank of Botswana from 1999 to 2005. He has a degree of economics from Bristol University, University of Bristol, a master's in economics from the University of London, and a PhD from the Open University in the UK. This is an Englishman with a difference. Originally from the UK, he now since defines himself as a Swana, I believe, that's the word. So I will ask Dr. Jeffries to begin with his presentation. Thank you.
Good morning, and thank you very much for the introduction, and thank you very much to IGC and Bank of Uganda for making arrangements. Yeah, so I'm, as has been said, I'm in Botswana, Gaborone, sitting in my office in the Ministry of Finance, from where I'll be making the presentation. So I'm going to switch over to sharing my screen and talk for about 30 minutes on the research that we've been doing through IGC, and hopefully that will now work. Great, looks like the slide has come up. So as has been mentioned, the main title of the research has been on the determinants of interest rate spreads in the banking sector in Uganda. The focus is on spreads, but spreads, as you will see, are very, very closely related to the levels of lending rates generally. So really, it's two ways of the same issue. So the presentation today will be divided up as shown in the outline. Firstly, I will talk about the motivation for the study and the research that we did. Part of the research involves looking at cross-country comparisons, and this is looking at spreads and other characteristics of banking systems in different countries. We then focused on Uganda, looking at the decomposition of interest rate spreads. We then did some detailed modeling analysis, and which I won't go into in detail, just summarize the results, but the details are in the paper that's available. And then we will talk about the policy analysis and the recommendations. When I say we, I should just let me go back and remind you of those who were involved in the research. So I was the team leader, and my colleagues were Liz Kasakende and Doreen Rubatsimbira from Bank of Uganda, from Research and Bank Supervision Departments, respectively, and Nicole Utungiri, who was then with IGC in Uganda. So that was the team that carried out the research. So let me explain why the study came about, and obviously it's related to concerns about the level of interest rates, particularly lending rates, which is a topical issue in Uganda as in many other countries. High bank interest rates, besides being painful for those who are borrowing, I think our concern as economists is that they may reduce economic growth below the rates that we may need or may be aspiring to, because bank credit is one of the sources of finance for investment. And if lending rates are high, then it may reduce the level of investment. As I mentioned, our focus is on the spread, which is the deposit lending spread, which is the gap between deposit and lending rates. And there are many different potential explanations for high banking lending rates and high spreads. One that's had a lot of attention is the level of competition in the banking sector. Is there enough? The level of bank profitability. So obviously if banks are highly profitable, that might also be driving up lending rates. The level of operating costs, the level of NPLs or loan losses, and whether there is a crowding out or competition from government, which might be causing problems in determining lending rates. So I think in Uganda, one of the big issues is concerns about bank profitability, and this is something that's been looked at over a number of years. There were some studies done back in the 2000s about the pricing behavior and efficiency of banks in Uganda, but not much has been done recently on this. So our study complements some of the earlier work and builds on the investigation of the banking sector and interest rates, but particularly looks at the period since the adoption of the inflation targeting monetary policy framework. And as I mentioned, the study has three key components. One is the comparative analysis with regional countries. One is looking at the interest spreads into the different components or drivers, which Dr. Mugume has briefly outlined. We're presenting some data on the components of spreads, and then we'll summarize but not go into the detail of some of the empirical or econometric analysis that we did. If I start by looking at the problem, if you like, what is the actual experience of the level of spreads? And we can see that comparing Uganda, this is over a period of roughly 10 years, slightly over 10 years, from 2007 through to 2018. We compare interest rate spreads in Uganda with a few other countries, Kenya as the blue line, Rwanda, South Africa, and Botswana. And we can see very clearly that interest rate spreads in Uganda have been consistently high, and they have varied in a range of 12 to 16%. But that is, I think, as everybody is aware, that's a relatively high level of spread. So I think this shows that there is a problem, or there's an issue that we have to look at. We then looked at whether high lending rates reflect abnormal profits in the banking system. And there's different ways of looking at profits. One is to look at return on assets, which Dr. Mugume mentioned briefly. We want a profitable banking system. Loss-making banks are dangerous banks. They're unstable. So we don't want banks to make losses, but also we don't want them to make excessive profits. And as I said, there's two ways of looking at bank profits. One is return on assets. Now, we don't show that on this slide, but the data does suggest that return on assets is now quite high in the Rwanda banking system, sorry, in the Ugandan banking system. But the other key way of measuring profits is return on equity, and that's essentially how much money are the shareholders making, the owners of the bank. And the left panel shows return on equity, and what this shows is that actually Ugandan banks' profitability is not excessively high. And in all these charts, Uganda is shown in as the red line, and you can see that it's not, return on equity as a measure of profitability is not excessively high. But on the right hand side, what we can see is bank capitalization, and this essentially shows the extent to which bank capital, which is shareholders' funds, make up the balance sheet of a bank. And capital is important because, firstly, strong level of capitalization means that banks tend to be more stable. Capital is a buffer; it can absorb losses. So a high level of capital does make banks resilient, but what we have to bear in mind is that capital is expensive. Capital is a source of funding, and the bank's other main source of funding is deposits. And capital is much more expensive than deposits as a source of funding. And therefore, as the proportion of capital rises as a source of funding for banks, they are using expensive funding, which has to be generated by return on assets, and may contribute to spread. So this suggests that Ugandan banks may be overcapitalized. Certainly by 2017, 2018, they had relatively high levels of capital compared to banks in peer countries. So that's something to bear in mind. We also looked at, well, what about the other side of the balance sheet? What about bank lending? And we can see that we looked at loans as a percentage of assets, and banks really hold predominantly two main types of assets. One is loans that they make to firms and households. The other is loans to government or government securities. And what we can see here is that in the Ugandan banking system, loans are a relatively small portion of assets. We can see here that the banking system, the composition of the asset side of the balance sheet is such that compared to other countries, loans make up a relatively small portion, and by implication that means that government securities make up a relatively high proportion of bank assets. Now, why is this? Well, that's quite easy to see. On the right hand side, we can see, we look at real government bond yields. In other words, how much money the banks make from holding government bonds and other securities. And we can see here that on the right hand side, the red line is very high, which means that banks can make a lot of money simply by holding government bonds. And that obviously gives them an incentive to hold government bonds rather than make loans. Of course, government bonds are relatively low risk. They're treated as a risk-free asset. Government's going to repay its bonds, whereas other borrowers may not. So the real government bond yield essentially sets a benchmark for all other forms of lending. So if you're a bank, one way you would approach this is why would I want to make risky loans when I can make risk-free loans and make a lot of money by lending money to government? And it also sets a benchmark for the risk-free yield, which means that all commercial lending to households and firms is going to be at a premium over and above the risk-free rate of lending to government. So it's quite important in setting a benchmark. The next thing we look at is whether administrative costs are particularly high. The evidence there is not all that conclusive. If we look at the cost to income ratio of banks, in Uganda's case, it's not out of line with other banking systems. But it could still be driving high lending rates, because if costs are high, then if banks then charge high interest rates, then their cost to income ratio will still be reasonable, but could be driving high lending rates. So that's briefly the comparative analysis. The next part we did was to focus just on Uganda and focus on what is the actual breakdown of the margin, the spread. And the spread we calculated, as we see on the left, we looked at across the banking system as a whole, the interest received on loans divided by the loan stock. So that's the average cost of loans, the average interest rate across all the different types of loans made by banks. And then we deducted interest expense over deposits. So how much, what's the average cost or the average interest rate that banks pay on deposits? Of course, some deposits pay low interest, some pay a bit more. So this was the average. So we took the average interest received on loans minus the average interest paid on deposits, and that was the spread. And the spread can be then divided up. What do the banks do with that? That is often called net interest income, and that net interest income is used to pay certain expenses, so the operating costs that are related to the intermediation function. Intermediation is converting deposits into loans. We then looked at provisions for bad debts, because when loans go bad, that has to be paid for out of the interest rate spread. Now, we also looked at the opportunity cost of reserves. Now, what that refers to is that a portion of deposits have to be held at the central bank as required reserves. And in most cases, those reserves don't earn the bank any income. But effectively, they've still got to pay for the cost of those deposits. Then they pay tax, profits tax or corporation tax, and then what's left is net profit after tax. So essentially, the spread can be divided or accounted for across all of those different types of expenses, and then profit is the residual. So we looked at the interest rate spreads across banks, the banking system as a whole. We were just looking at all banks using Bank of Uganda data, and the black line, and we did this over roughly a decade, 2008 to 2018, and so the black line is the actual margin, the spread in each year. It varies from year to year, but it's been fairly consistently high. And how can that then be disaggregated across the different types of contributors or cost drivers? And you can see fairly clearly that in all years, it's this green portion, it's the operating cost that is the main the main expense that goes into spreads. Then we have cost of holding reserves, the yellow portion, is smaller, but it's still significant. Profit is not that high, although it does vary a lot from year to year. But profitability overall. The next one is provisions for bad debts is quite important, and then there is tax. So you can see that overall how the spread is divided up. This slide here just shows that really the numbers behind those that chart and some averages. If we can just look over the left-hand pair of columns here, shows the period over the experience over the period as a whole, and you can see that on average operating costs down here account for 61% of the spread. So of the average spread of 12.9 percentage points, operating costs make up 7.8, and the others all contribute different amounts. Cost of reserves 11%, loan loss provisions 12%, profit just under 10%, tax about 7%. We then looked at how does the decomposition vary by different types of banks, and we divided the whole banking sector up into different ways, and we looked at what's the decomposition of the spread across different types of banks. This one shows large banks and small banks. Large banks tend to have slightly higher spread, but they have significantly lower operating costs. The cost of holding reserves is a bit smaller amongst the big banks. The small banks pay relatively little tax. You can see why on the right. That's because they are not in general very profitable. They also have to make higher provisions for bad debts. So there is a bit of variation in the composition or the drivers of the spread by banks of different sizes. We also looked at banks by ownership, foreign banks and domestic banks. I believe most of the banks are foreign owned, but there are some that are domestically owned. And we see that the spread is much lower in the foreign-owned banks than in the domestically owned banks. And that is also driven by differences in operating costs. The foreign banks have much lower operating costs, but the domestic banks are more profitable. So that's a contributor to their larger spreads. We also looked at, we tried to divide banks into by operating efficiency. Now, we couldn't directly measure this, but we looked at essentially banks that made small loans and banks that made large loans. So the blue columns show banks with relatively small loans on the basis that banks making small loans will have relatively higher costs of monitoring loans and administration, etc. Then we also looked at banks that make larger loans, and you can see that the level of the spread is much higher in the banks with lower levels of operating efficiency because their costs are significantly higher. On the other accounts, they don't vary very much, but banks with lower levels of efficiency have much higher levels of operating costs and wider spreads as a result. So, what are the conclusions? The summary results of this decomposition? Well, across all categories of banks, operating costs are the major contributor to spreads. And the second largest is provisions for loan losses. There are some differences across different categories of banks about the importance of taxes. Cost of required reserves is the third largest contributor. And then profitability, while profits have been an important driver of spreads historically, it's been surpassed by the cost of bad debts in more recent years. So, broadly speaking, and we'll get to the policy conclusions shortly, but we can see that one of the big drivers of spreads, operating costs, provisions for bad debts, cost of reserves, whereas profitability is and taxes are less important contributors, and you can see that this is starting to point to policy conclusions. The third part of our research, which won't go into in detail here, but you can look at it. It's in the paper with some quite detailed modeling of interest rate spreads, and we use very detailed data for all of the banks across a period of time from 2012 to 2018, and so we have data for each bank in each year, and we related the spread to issues around market structure, the measure of we brought in macroeconomic variables such as economic growth rates and the real exchange rates and the real 91-day treasury bill rate. So this is starting to provide a link to policy and market interest rates. And we found that, to summarize the results, that the return on assets, that's one measure of profitability, had a positive impact on the spread and was very significant in statistical terms. Similarly, with overhead costs, they were also a strong driver of spreads. We included a dummy variable for foreign banks and found that that was negative, so it tended to bring spreads down. Non-performing loans was positive, but was not a very strong determinant in statistical terms. The Hirschman-Herfindahl index is a measure of market structure, and it suggested that it's related to really the extent to which large banks dominate the banking sector, and this had a positive impact on spreads, suggesting having a few large banks does tend to drive up spreads as well. Real GDP growth was positive, so when the economy is booming, banks are in a stronger pricing position. The real effective exchange rate was negative, and the treasury bill rate also had a positive influence on spreads. So let me turn to looking at some policy conclusions and recommendations, and hopefully this will inspire some discussion. Firstly, encouraging more competitive bank spreads, and we think that the way to encourage competition is not to have more and more small banks. And the reason we don't think that is very effective is because, as the analysis also shows, that small banks have much higher operating costs. What we need to see is that smaller and medium-sized banks should actually be encouraged to grow so they can challenge the dominant banks. To be honest, lots and lots of small banks don't really challenge the dominant large banks. And maybe that could be done, as we suggested in the second point, by encouraging the consolidation of smaller banks. So I think what is clear from the experience of other countries is that large dominant banks are challenged by growing medium-sized banks, not by small banks. And so maybe, as other countries have done, if you increase the minimum capital requirements for banks, then that tends to encourage smaller banks to consolidate into medium-sized banks, and they can then challenge the larger banks in terms of competition. The second set of recommendations are around operational costs or overhead costs, which is clearly the biggest driver of spreads. And we saw that operational costs, overhead costs, contribute about nearly 8% of the overall spread, about 60% of the spread in total. And certainly other banking systems show that banks can exist with much lower levels of overhead costs than operational costs. In fact, somewhere around 4 to 5% would be a sign of a more cost-effective banking system. So what can be done, or what's the driver of these high costs? Well, clearly there's a lot of duplication of infrastructure. Again, too many small banks leads to, banks have a lot of fixed costs: infrastructure, payment system, branches, personnel, etc. And so the more small banks you have, the higher going to be your operating costs of the banking system. But also branches are expensive, so reducing costs really needs to be driven by continued transition to electronic platforms. As I've said, consolidation of smaller banks would reduce duplication of infrastructure and enable economies of scale. And we also need to look at whether there are regulatory requirements that add unnecessary costs which can be avoided. NPLs, non-performing loans, loan losses, so contribute to spreads because those bad loans have to be financed by the money made on other loans, and therefore the quality of credit risk assessment, if that can be improved, that should also narrow the gap. So we need to look there at issues around the functioning and the accuracy of the credit registry. Is that helping banks to really make better credit risk assessments? And also the legal processes involved in realizing collateral. If that takes forever and is unproductive, then that will increase the cost to banks of defaults. A third level of recommendations is, well, the first one is around the cost of reduction of government borrowing. Clearly, we can see that the cost of government borrowing is very high in Uganda, and provides a very lucrative and attractive asset for banks, and is really the benchmark rate around which all lending rates are set. And so if the amount of government borrowing or the amount of domestic borrowing in capital market could be reduced, then that could lead to lower treasury bill rates and bond rates, and reducing interest rate spreads that way by reducing the comparative attractiveness of the risk-free assets that are open to banks. We can also look at whether the banks are overcapitalized, and certainly the indication is that banks do have relatively high capital, leading to a need to generate high return on assets. And from a regulatory point of view, it might be helpful to look at whether there are some regulatory aspects which are encouraging or providing incentives for banks to become overcapitalized. So this is overcapitalized over and above the normal capital adequacy requirements. All banking systems have requirements for bank capitalization, but it seems to be the case that in Uganda, banks are overcapitalized relative to what the regulations require. But are there some aspects of the regulations that cause them to become overcapitalized? Competition doesn't have to come from domestic banks. We could encourage competition through regional banking integration in line with the East African community. And if we look, say, in the EU, where there is a high level of cross-border banking competition, a bank licensed if you look at the EU, say a bank licensed in Germany can do business in France and vice versa on the basis of a single banking license. They have a system called passporting, which means that if you're licensed in one member state, you can do business in another member state without requiring another license. Is that something that should be looked at in the EAC, which would encourage cross-border banking competition? We think that could be quite important. And then looking at competition from non-bank lenders, I think increasingly the general approach towards financial inclusion and access to finance is to look at the products rather than the institutions delivering those products. And clearly technology is allowing a whole range of different types of institutions to provide financial sector products. And allowing mobile money operators would be the obvious one, but there may be others. In other countries, we see various types of fintech institutions coming up with innovations. I've done some work in Nigeria where that's quite a booming scene. And I think competition from non-bank lenders can also provide competition from banks and maybe can also contribute to reducing spreads. And I just want to make one other point, which is actually not mentioned on the slides, but it's come up in our discussions amongst the team while we were preparing. And one of the issues that came up was concerns in Uganda that bank lending rates don't respond to changes in the policy rate, in the CBR, central bank rate. And there seems to be some concern that bank lending rates don't change when the policy rate changes, or won't change enough. Certainly in Southern Africa, I know this is the case in Botswana and in South Africa, there's a much tighter link between policy rates and bank rates. So, for instance, here in Botswana, the commercial bank's prime lending rate is regulated to be 1.5% above the central bank rate. So that when the central bank rate changes, the commercial bank's prime lending rate goes up and down immediately with the policy rates. I think the banks are given 24 hours to make that change. And of course, the prime lending rate sets the benchmark against which all bank lending rates are set. So certainly here in Botswana and South Africa, we see that when the policy rates change, the bank rates follow immediately, and by an equal amount changes in the policy rates. So I'm not saying that should be done everywhere, but it's just an example of how a stronger link between policy rates and bank lending rates can be established. So let me finish there. That's the end of the presentation. I hope I've kept roughly to my 30 minutes. And I look forward to the discussants' comments and responding to questions in due course. Thank you very much.
So, thank you, Dr. Jeffries. I hope it was not too technical for the majority of the audience. But I will not try and summarize this paper. That's not for me or to comment on. For that, we have the privilege of having Ms. Rashmi Pillai, who, when I go through her CV, it's impressive. She's the digital financial services specialist who has worked with a consultative group to assist the poor, SIGAP at the World Bank, was an advisor to the Ministry of Finance in Rwanda on the development of their national payments strategy on behalf of the Better Than Cash Alliance under the UN Capital Development Fund. She's a co-founder of Sankalp Forum in India that enables for-profit social enterprises access funding from investors. And in the period 2009 to 2012, when she managed this particular forum, she actually managed to channel approximately $45 million to some of these social enterprises. She has over 13 years of global development practice and experience, and is currently the executive director of the Financial Sector Deepening Uganda, an agency that is focused on thinking and doing all things financial inclusion and inclusive financial market development. She has a master's in let me get this right, in spectroscopic physics from MS University in Baroda, India. She's also a Fulbright scholar and has a master's in public policy from the Kennedy School of Government at Harvard University. Ladies and gentlemen, allow me to welcome Rashmi Pillai to discuss the presentation by Dr. Jeffrey. Thank you.
Thank you, Dr. Chwenemanzi, and good morning, everyone. Thank you to the Bank of Uganda and the International Growth Center for inviting me here. It's an honor and a pleasure. I also look forward to hearing from the panelists from UBA, at Wilbrod, the Ministry of Finance, from Moses, from Gideon, from PSFU, and Mr. Everest from CASITA. As a discussant, I will I will discuss the paper by Dr. Jeffries, Elizabeth Kasakende, Doreen Rutasimbira, Nicole Tujire. At the beginning of this presentation, Dr. Mugume talked about the evolution of Uganda's financial sector. One of the other evolutions, because when I was young, when you talked about central banking and policy making, you always saw men up on the stage. So we have 3 women who co-wrote this paper, and it's my honor to discuss this paper that has seen a lot of women participating in central bank policy as well as government policy. When I looked at my role as a discussant, there's an informal aspect that I was joking with Dr. Twenemanzi. I looked at the agenda and said, well, they're all men, so clearly I have to represent the women. That's a huge burden. And then there's the formal aspect. As Executive Director of Financial Sector Deepening Uganda, a think tank that's exclusively focused on inclusive financial markets that serve the needs of everyone, the poor and small and medium businesses, I see it as my job to break down this fantastic paper and then bring it down to the level of why do some of these issues raised in the paper matter to businesses and people? How do some of these policy actions or inactions affect everyday businesses and everyday individuals and their aspirations and goals? Okay, so as I mentioned, the first question that I have is why should you care about bank interest rate spreads, and how does it affect everyday Ugandan and Ugandan businesses? So let's break this down. As Dr. Jeffries mentioned, banks are financial intermediaries. Like any intermediary, they bring parties together, different parties together. In the case of banks, they bring savers or depositors and borrowers together. The interest rate spread is the lending interest rate at which a bank gives a loan, less the deposit interest rate, the interest rate that it would give you if you were a saver. If financial intermediation, that is matching depositors' money to lenders who want to use, to borrowers, sorry, who want to use that capital for productive investment. So that's financial intermediation. If it's done well, the difference should be small. But in the case of Uganda, it is big. This is the premise that the paper examines. Commercial lending rates, as we heard from Dr. Jeffries, typically average around 20%. And the deposit, in a good case scenario as a saver, you would get up to 5%. So there's a difference of 15%. And the paper talks about what makes up this 15%. Now, one of the things we ask is, why should you care about this? You should care about it for 3 reasons. A high interest rate spread with high cost of borrowing affects the growth of businesses and their profitability. It impacts retail borrowers trying to match the shortfall between current expenditure and income. But more importantly, if financial intermediation is not done well, or if there are big impediments to efficient financial intermediation, it handicaps economic growth. Therefore, it is imperative to understand why bank interest rate spreads are high in Uganda and what are the factors that influence it. So the first hypothesis of the paper that they ask, and we heard from Dr. Jeffries, is the interest rate, the spread could be high because banks are making abnormal profits. Yes or no? So the paper examines that. And the conclusion is not really. Banks in Uganda are not making abnormal profits. They look at profitability through 2 metrics. One is return on assets, and the other is return on equity. And I'll go into a couple of slides around that. In the case of return on assets, when you're talking about assets in a banking terminology, what does that mean? It means that banks make income when they give loan to people and businesses. They make income with government securities because they invest in government securities, and if they have cash and other investments. So we would typically expect banks to lend to customers and businesses. But if you look on the figure on the right, that's from the paper, You will see bank advances, which largely means here loans, and you'll see the red line, which is Uganda, are less than 50% to businesses, or average close to 50% for businesses and consumers. So where is the lending going? That is the next question. If loans are making up 50% or less, then most of the lending is, and the paper shows this, is a large part of it is going towards government bonds. Ugandan government bonds yield at least double than their counterparts in SADC and East African countries. And government bonds set the rate for cost of borrowing for a business or for a consumer. If government borrowing is very high, meaning it is profitable for a bank to invest in government securities, the government has crowded out private sector credit. So high government borrowing, especially if it is not channeled into productive investment, can have detrimental effects. One, for borrowers, bank loans become expensive because the floor itself is already very high to begin with. Second, it disincentivizes banks to grow their loan portfolio and find new greenfield projects to lend to. And third, it increases bank aversion to risk because government bonds are risk-free. You can make money with no risk. And if you're making more and more money with less risk, do you know how to then take on additional risks? Have you created mitigation mechanisms? Have you changed a bit the business models? Have you changed efficiency that comes through technology to handle risk, to invest in greenfield projects? So the question here for this subsection, and I'll leave that to Dr. Twinemanzi to ask as the moderator. Hopefully he'll pick some of these up. The paper mentions that the return on assets for Ugandan banks is relatively high, second highest in the region. But the question that we should also ask is what needs to be done so that banks are incentivized to lend to businesses and consumers at affordable interest rates that drive the economy forward. Now let's continue with the hypothesis. The other part of the profitability that the paper examines was on return on equity. So it talks about Uganda being a low deposit environment, and I'll show a slide following this that gives credence to this fact. And it also talks about, because the banks are, have lower deposits, they are capitalized using external funds or expensive term deposits. The cost of these funds is more expensive if you compare if the banks had cheaper deposits. The paper posits that banks are using high-cost capital to lend money to borrowers. And because these banks have to make returns for this high-cost capital, it puts an upward pressure on the lending rate and therefore the interest rate spread. And the paper also talks about bank capitalization, a high capitalization. And it's shown that they don't have enough deposits, a lot of external capital coming in. The question I hope that this paper would have addressed, another aspect that could have been addressed, was why is bank capitalization persistently high? What is driving some of this behavior? And why are they holding on to this capital? You could argue, well, one is bank risk aversion. They're creating buffers and have become risk averse. The other could also be liquidity mismatch. Depositors, and I'm sure Will Broad will attest to this fact, save their money for extremely short durations. There's a high degree of volatility as to when depositors will withdraw their money. Therefore, in contrast, borrowers are looking for longer-term financing. Therefore, you have short-term deposits, but borrowers were looking for long-term financing, and there's a mismatch between them. And that's what could be another potential explanation of why they're holding on to such buffers. I mentioned that I will talk about the low deposits. If you look at this chart from FinScope in 2018, you will see a column which has banks, and towards the right-hand side, you'll see a column that has savings groups. And you will see that this entire chart has been divided by wealth categories, urbanity, gender, and age. I'll just draw your attention to the wealth categories. And you'll see that only 3% of the poorest adults in the country do business with banks. Of the middle income, only 13% of adults do business with banks. And of the richest, only 23% do business with banks. Now let's contrast that all the way with savings groups on the right. And we'll see that savings groups across all these wealth categories are outperforming banks. So the question then for the moderator and the panel is, given what we have seen on return on assets and return on equity that the paper draws on, do shareholders and capital providers of banks have an incentive to push banks to grow their non-government portfolio? Does the current structure of the economy allow for the above? What needs to happen to incentivize banks to increase their deposit base by several multiples? Alternatively, you could ask, what do banks need to do to acquire deposits that are lying in informal Tier 4 institutions or under people's mattresses, thus gaining much needed cheaper deposits and the pressure and lowering the pressure on profitability and lending rates? I'll give another example here. I found this very interesting. Banks in Uganda, and maybe Wilbrod will help us understand this better, and maybe including the Ministry of Finance, banks in Uganda typically lend against immovable collateral, collateral that cannot move, so your home or your land. Now let's examine this chart by FinScope, and you'll see that the number of people were asked, do you own a home? And if you look at yellow and red, 28% don't own a home, 19% don't individually own it, it's owned by somebody in the household. So if you had to lend as a bank, close to 47% of the adult population does not have a home in their own personal name. Now, if you look at land ownership and just look at title deed and land agreement, only 19% of adults have a title deed or a land agreement. What this means is that very quickly the banks are going to reach market saturation because they lend only against collateral, or that is their primary form of lending. What about immovable collateral? Uganda made strides on this last year by when it passed the Electronic Movable Collateral Act and regulation, set up an electronic registry. We still have a long way to go on that. Let's compare how we're doing to Kenya. This is a graph from the Kenya Bankers Association. And you'll see the various movable collateral that a variety of banks in Kenya are using to lend to businesses and people. Most people in Uganda do not have immovable collateral. The question then becomes, how are we changing banking models? When we talk about operational costs and efficiency, how are we forcing banks to change their models to meet people and businesses where they are? Just as a highlight, by end of January 2019, according to the Kenya Bankers Association, 183,000 loans were registered on the movable collateral registry worth $36.5 billion. All right, the second hypothesis that the paper has is the spread is too high because of costs around operations and functioning of a bank are too high. And there's the graph on cost to income ratio, which is a key banking metric that the paper talks about. In Uganda, the range has been between 50 to 60%, and the paper says it's not much out of line with other countries, but it's important. And we'll see that in the next slide. It also talks about loan loss provisions, and this is important because if you have high non-performing loans, you will have to keep provisioning higher as a bank. And there's a cost to that capital. The other factors that the paper talks about is impact of inflation because it increases the costs of doing business. It talks about the regulatory environment and the costs of regulatory burden that Dr. Jeffrey mentions and other authors mention, which is liquidity ratios. And the third one is taxation. So if you look at the decomposition of interest rates, and if you look at the spread, which is at the bottom, we will look towards the right-hand side where you can see the highlights in the columns. And you'll see the spread, let's say it's 13.2. Deposit rate minus borrowing rate, 13.2. What makes up that 13.2 percentage? And if you look at the percentage share, you will see that 59.1% is operating costs, which is what Dr. Jeffries was talking about. The other one is the cost of reserves. Those are, I believe, and the third one is loan loss provisions. These are the three big drivers that Dr. Jeffrey was mentioning about. And the conclusion that the paper has, and we agree with, is that operating costs are very high. They're at close to 60% for banks, and they're putting a pressure on the interest rate spreads, apart from other costs like holding reserves and taxes. So hopefully Will Broad and Dr. Twinemanzi will tell us how banks are going to revolutionize themselves and lower their operating costs. The paper also makes some very interesting comparisons based on clusters of small banks versus big banks, ownership structures, are you foreign owned or local owned, and high loan to account ratios. What it discovers is that the latter two, which is the ownership structure and high loan to account ratios, have a significant impact on the interest rate spreads. And hopefully the moderator will talk and walk us through why some of that is. Dr. Jeffries mentioned that we do see operating costs as a significant influencer when you look at these clusters. But maybe the panel will also highlight what are the ingredients of those operating costs, what make up those operating costs, and how do they influence ownership and high loan to account ratios. Finally, I've taken two big recommendations from the paper. I hope the authors will forgive me for picking and choosing. One of the key recommendations was increased competition and potential consolidation of banks through raising minimum capital requirements. We agree, everybody in this room and hopefully online viewers can agree that there is a need for increased competition. The question I have is bank consolidation actually going to be driving that competition? Or is it just going to increase the collusion power of banks? Are we going to see what we see in the telecom sector, an oligopolistic market? Because we'll have few highly concentrated banks. The second one, just as a brief aside, Dr. Jeffries had a couple of ideas that we could talk about: fintechs, mobile money, environment. Yes, we could talk about that. The question I hope that the panel will ask is, do we have an enabling environment to allow for those innovations to grow? We just passed the National Payment Systems Act and regulations that are in the making. Are we allowing for those innovations to foster? Or are we just taking some of our legacy regulatory approaches to a very innovative, nimble environment? The second question, recommendation, was reduction in NPLs, non-performing loans, which would help loan loss provisioning through better credit risk management. Now, this is an important recommendation. The question here is, how are regulators creating an enabling environment for banks to adopt new innovations and technologies at costs that are favorable to people and businesses? The paper talks about information asymmetry. It's an important concept because banks don't know enough about Rashmi. How are they going to lend to Rashmi? Rashmi may bring some collateral, but they may also add some premium because they don't know enough about her. So how do we reduce that information gap? And how do we make sure that that information is accurate, it's validated? There are multiple steps that the country can take. One is leveraging our national ID infrastructure, creating a national ID architecture that responds to the needs of the financial sector in reducing information asymmetry. The other is we've been trying to have the accredited credit provider regulation for some time. As most of us know, Only tier 1 to tier 3 supervised institution can actually give data to CRBs. But the bulk of the population does businesses with SACCOs. They do businesses with money lenders. How do banks not know whether I have borrowed from 5 different SACCOs and I'm now coming to them? They have no understanding of the risk that I pose to the sector and to them. Allowing these credit providers to provide information to the CRBs could help reduce information asymmetry. I'm sure the panel will have more ideas on how this can move forward. I will leave Dr. Twinemanzi and the panel with 2 big questions. Given what we have heard and discussed so far, does the structure of our economy and the incentives it provides, does it truly push banks to do financial intermediation, which is their primary role? And the second, in the midst of a global pandemic, does it exacerbate the current systemic issues we are facing, leaving customers and businesses worse off? Thank you.
Yes, thank you, Rashmi. Very detailed discussion of the paper by Jeffries. I think at this point, ladies and gentlemen, what we're going to do now is turn to our panel of preeminent experts. I know between the 4 gentlemen, I believe they have close to 100 years of experience, even though none of them is anywhere near 100. So, if you will allow me, ladies and gentlemen, I'll just introduce these eminent persons to you. And I'll start with Mr. Everest Kayondo, who is the chairman of CICA, which is the Kampala City Division. So, with Mr. Kasita is the chairman of the Kampala City Traders Association. He's the chairman of the Association of Uganda Tourism Operators. He's a businessman in his own right and has made his name that way. And I'd like you, ladies and gentlemen, to put your hands together for Mr. Everest Kayondo. Well, now, this is in no particular order of importance, so none of you should feel slighted. There's no pun intended. The next is a gentleman, for those within the financial sector who needs no introduction, Mr. Moses Kagwa, who is the Director, Economic Affairs, representing the Permanent Secretary and Secretary of the Treasury Minister of Finance, couldn't make it today. Mr. Kagwa, before he became the Director of Economic Affairs, was the Commissioner of Taxation. So if you have an issue with the taxes you pay, that is the man you throw your stones at. He's a graduate of the law school at Makerere University, and I would say a point man in the Ministry of Finance in terms of getting things or anything done in that ministry. Mr. Kagwa, you're welcome. Another gentleman, Mr. Gideon, and I hope I won't pronounce this badly, Badagawa. Like I said, over 20 years experience as an academician, businessman, private sector representative. He is currently the Executive Director of the Private Sector Foundation, Uganda, a position he has held for the last 11 years. And prior to this, he was even the Executive Director at Uganda Manufacturers Association. He sits on numerous boards. He's a graduate of the Institute of Statistics and Economics at Makerere. He's completed a postgraduate diploma in environmental management from the Maastricht School of Management in Netherlands, and has a master's degree in development economics from the Institute of Social Studies at Erasmus University in Netherlands. Welcome, Mr. Badagawa. But just to make sure I don't mispronounce your name, you'll allow me to call you Gideon. Last, and like I said, again, no offense, Last is Wilbrod Owor, who has over 25 years experience in the banking sector, including serving as MD/Chief Executive Officer of a commercial bank in Uganda. His experience spans banking business development and financial sector policy advisory and advocacy. He currently is the Executive Secretary of Uganda Bankers Association, the Industry Association of Policy Advocacy that focuses on industry policy advocacy and brings together all commercial banks, credit institutions, and microfinance deposit-taking institutions. He has a Bachelor of Commerce degree, finance, from Makerere University, and also holds an MBA in Strategic Management from ESAMI. Welcome, Mr. Wilbrod Owor. If you'll allow me to, step up here. We've just had a discussion in terms of, we've had the discussion by Rashmi in terms of the key factors that were found critical in this study. And I think at this point, there was something that was mentioned and that I believe that is critical, which is that one of the key drivers tends to be the risk-free rate embodied in the cost or the level at which government borrows. So in essence, the hypothesis seems to be that the attractiveness of government paper or government borrowing effectively determines the risk-free rate, which is the floor for the lending rate. This is something that both Dr. Jeffries and Rashmi spoke about. So the question, and this I direct to Mr. Kagwa, it appears that's apparent that the government appetite for domestic borrowing has some kind of unintended consequence with regards to the pricing of credit within the economy. The question, first and foremost, what is your response to this particular finding? Because I may make a presumption you agree when you don't. Mr. Kagwa.
Thank you, moderator. And is it still morning? Good morning to you all, and the ones who are here physically, and the ones who are virtually, and then the ones on TV. I agree partially, and I don't agree partially. Why is it? Because government going into a domestic borrowing, especially for financing of the budget, is a recent development. It's very new. It's not has been over. But when you look at the interest spreads over a period, or even the interest rates over a period of 15 years, you'll still find that there's not been an upward trend, that they are going up because of that government has increased this appetite to borrow. So that is something that we need to really investigate and see. Yes, I know government borrowing may have an impact or an effect, but it's not all. Of course, when we borrow, right now, it's almost 10 trillion when you look at it. Both for the financing of the budget, which was about 2.9 trillion last financial year, and the rest is what we call the rollover. That's a huge amount. But that is against the backdrop of the private sector credit, which is out there at 16 trillion 982 billion as at the end of last financial year. So there has been this money which is being lent almost 20 trillion over that period of time, but the interest rates, when you look at them, are very high. And then, for me, I would still want to look at the sectors that the banks have actually been involved in. Mortgage, buildings, construction, and real estate, taking a very big chunk of the money. Then trade. Then we find that there is personal and household loans. And then agriculture comes down a bit, and then manufacturing. So when I look at this, first of all, the banks, their tendency from the statistics is to lend to sectors that, for me, I wouldn't really call productive. We can have a debate on that. There's a lot of dead capital when you put up a lot of buildings, and the cases we've had coming up of recent have not been that the banks were financing this manufacturing plant, and there's a problem. It's buildings, it's what. So the focus, and I don't know whether that would change the focus of the banks if government was to borrow less. But that said, still I agree that certainly government borrowing has a big, has an effect on interest rates, because in a way, yes, we do crowd out private sector to a certain extent. We do, as it has been shown. But I know there are other factors that are leading to this, and that is something that we should really be looking at. Thank you.
Thank you, Mr. Kagwa. I think there's something you've mentioned right there, that perhaps the interest spreads might be, or the interest high spreads or the levels might be influenced necessarily by the structure of the kind of lending they do. That the composition of the lending matters. That seems to be what you're suggesting. But I think that is kind of related to the findings by Dr. Geoffrey. Because if it's those sectors that the banks are focusing on, perhaps, it's possible that's associated with the overhead costs that they incur. And this is now where I turn to my colleague Wilbrod. That since, as alluded to by Mr. Kagwa, Dr. Geoffreys, overhead costs consistently, and from a statistical significance point of view, statistically significant in explaining almost 60% of the spreads. These high operational costs, first of all, I'd like, for the purpose of those who are listening and attending this session, first of all, what normally goes into these operational costs? What's this animal called operational costs, first and foremost? Second, that is it a reflection of perhaps operational or technical inefficiencies in the way banks perform the intermediation role? That explains why then that they have to recover that. Basically, what they are recovering is not just cost, but cost plus inefficiency. And if that is the case, what do you think either perhaps the policymakers, the Minister of Finance, or Bank of Uganda, or the policy advocacy group represented by Private Sector Foundation should be pushing for to help bring down these overhead costs? Wilbrod.
Thank you very much, moderator. And thank you, Dr. Keith, and the team that you led in the paper that have been very ably put across. Extremely insightful. Thank you, Rashmi, for your discussion paper. You have made work very easy for me. I think you went in great depth to explain the issues. But nonetheless, a lot of insight is brought into the table by the paper. The moderator has asked us about this animal called overhead costs. What is in it? Is it indicating inefficiency on the part of banks? Or if not, what else can be done? Yes, First of all, I want to say that Dr. Keith's paper brings out very many important issues. We largely agree with quite a number of them, not all of them, but a number of them. And Rashmi just cemented our position on many aspects. And in very many ways, we nearly agree with Rashmi's paper, 100%. This animal called overhead costs are typically the cost of running the business, if you like. And they entail staff costs, infrastructure costs, not limited to the ICT infrastructure that runs financial institutions, the buildings, and all related utility and running costs. There are recovery costs when we give out loans, and it's not just chasing a person. It includes costs of sustaining a court case for 4 or 5 years until the loan is paid, and other regulatory costs of meeting compliance requirements. And these are huge, especially if quantified from a percentage point of view. And indeed, they have a big bearing to loan pricing. Is it a sign of inefficiency? Yes, partly. You could say so. That I think there's a lot more room for us to do better, either by leveraging technology or doing business smarter. But the cost of doing any business depends in the market in which you operate. And therefore, there are some external factors that equally drive these costs. So the efficiency with which those external factors are resolved, and I just threw one case, one aspect of courts and how long it takes, the cost of some of the basic IT infrastructure. But I think we are here to find more solutions, policy options. And I think continuously leveraging on technology will be critical, finding better ways, but the underlying solution really is to expand the business so that we reach more people, mobilize larger and a big amount of deposits into the financial system, because just by economies of scale, it makes it then easier to operate. So that would be my initial response.
Yes. Thank you, Wilbrod. So you mentioned that perhaps leveraging information technology can bring down these overhead costs, but then when you look at the average cost structure for the average commercial bank, the information technology tends to be a very large cost center. So maybe perhaps we are yet to see the benefits of that capex expenditure translating into a reduction in overhead costs. But this time, I would like to turn to my colleague, Dr. Mugume, on something that has come through on the forum, the online questions, is there's an observed downward stickiness of interest rates as they respond to movements in CBR. So the first question that people want to understand is why. Dr. Mugume?
Well, I think that is a valid observation, mainly so in the recent past under COVID. That's why I've seen more stickiness than before, simply because also the economic activity is not as favorable. Indeed, I think we heard from Rashmi and also from Jeffries that the floor is set by Mr. Kagwa. Mr. Kagwa is denying the fact that he sets the floor. So if Kagwa, as through Minister of Finance, is borrowing at 15, and your CBR is at 7, and he's still borrowing, so whether he reduce CBR again, so long as Mr. Kagwa still has appetite, they won't respond. That's a fact. Because he sets the floor. That's what we have had. I think setting of the floor becomes instrumental. In days when we saw quick responses is where domestic financing needs were less compared to now, and therefore you reduce the bank rate, or so the CBR, there is liquidity, there is nowhere the commercial bank report the liquidity, therefore it has to lower rates to get the customer. But now you lower the CBR, Kagwa is willing to take at 16. So why should the commercial bank also remember that they are looking for return on equity and return to assets? So why should they reduce? By the way, I'm not supposed to ask the governor.
Dr. Mgume, I'm asking in your capacity as Executive Director Research. The presumption is you put down the heart of the governor. So this is the follow-up question to you, for that matter. So you talk of a disconnect between the CBR and the government appetite for domestic borrowing, and that therefore subsequent movements or perhaps the application of monetary policy, now there remains a question mark about the effectiveness of monetary policy. So how effective, in such an environment where you have a significant disconnect, and I think Jeffries gave us the example of Botswana, where you have a significant disconnect between the CBR, the flow or the risk-free rate, which is the rate at which government borrows, and therefore this downward stickiness which we have acknowledged, we have seen in the recent past, and is only currently being exacerbated by the current situation, or financial situation that we find ourselves in as a country.
So that's another valid observation. In the current environment, let me be frank and say that the central bank, in terms of policy effectiveness, becomes, it is true, it becomes less effective, simply because, as I said, banks are not really not going to respond to whatever you are, whatever you are doing. So monetary policy efficacy becomes less, and I think we have observed it. Then the question will be, the only real way is to say, okay, at least you are providing. Now, let us go on the other side. Suppose Mr. Kagwa or Mr. of Finance is borrowing the money that is going to spend it, in good projects that have high returns. So, but on our side also, by reducing the policy rate to 7, or even, even if we were to go wrong, although the private sector may not borrow, to some extent, we are helping Mr. Kagwa to borrow at a lower cost. So if he spends that money efficiently in terms of boosting economic activity, although on Bank of Uganda's side we are less effective in stimulating credit to private sector and lower interest rate, but at least through Mr. Kagwa borrowing relatively at low cost and doing an infrastructure project that has high returns to the rest of the country, then at least we will be also equally supporting economic growth.
Thank you, Dr. Mugume. I now turn to Gideon. You see, one of the policy recommendations, and that was something that Rashmi referred to, is about increasing competition in the banking sector. So first, Gideon, is this lack, apparent or otherwise, of effective competition only unique to the banking sector, or it is something that is prevalent across the private sector in general? Gideon.
Thank you. Thank you very much, moderator. And I also want to join my colleagues in thanking the presenters, Dr. Keith and Rashmi, for a very well articulated paper and quite well discussed. Thank you very much, Rashmi. Now, I'll get to your question about competition. And I will say directly to you that competition alone cannot do the trick. Because the question we are asking in this seminar, why are interest rates high and what can we do about it? Now, inviting competition can be one of the solutions, but there are many other solutions that must precede this competition. You can have 100 banks, but as long as you have not fixed the whole aspect of cost of doing business, Wilbrod will still tell you about the cost of doing business, about the overhead. So each of the 100 banks will face the same overheads anyway. If you have not addressed the whole aspects of the risk premium that we all face, because why are NPL, why are the non-performing loans on the rise? It's because of the risk that is associated with borrowing. Now, if we are in such a situation where even up till now we have a national ID that has not been linked to the Credit Reference Bureau to be able to do the referencing, like Rashmi indicated earlier, these are rigidities, structural rigidities, that even if you invited competition, you'll not be able to bring down interest rates. If we still have a situation where government is spending recklessly and going to the domestic market and borrow money through the banking system, the treasury bills, like Adam is saying, will invite the banks to respond to the 15%. Now, whether you have 100 banks in terms of competition and so on, as long as we have not fixed our priorities and put our money where wealth will be created and invite the private sector, we continue to crowd out the private sector. If it's about the cost of money, and all these are determinants of interest rates, the risk premium, the treasury bills, the cost of money itself, and the question is, are banks borrowing to lend? Because we have indicated that the CBR is the price of money. So once it's 7%, then we should be able to see the interest rates come down. They are not. They are still 20%. So while the governor is trading all the way down, the banks are still there for various reasons they have indicated. So the structural rigidities in the economy require that we all, because the public out there, the borrowing public, is looking to us. None of us in this room doesn't know why interest rates are high. We're asking the question in this room, and we have asked it before. Why are interest rates high? The public out there, the MSMEs, who constitute 90% of the private sector in this country, are asking, if I'm in agriculture, can I borrow at single digit? And how can that be? 8%, 7%. You can't borrow at 20% and do agriculture. Some of them are saying, can we have an agricultural bank? Maybe that is not the trick. That is not the solution. The solution lies in the government fixing the priorities. And one important thing, and I think, Moses, really, we need to pay attention to this. Because I heard this year, we are going to borrow, or we are planning to borrow 4.3 trillion from the domestic market. I've heard that. And I've been to Parliament on this to ask the question, why? Because amidst COVID, amidst all these political challenges that we are in, if we are going to borrow from the domestic public and through the commercial banking sector, we are likely to mortgage the future of the private sector in this country. And two, and again, this is question to Governor, is it possible that we can borrow directly from the public by issuing a bond, maybe over 3 years, go through the securities exchange? Do it maybe 50% the first year, 25% second year, and 0 at the end of the 3 years. You don't have to go through the commercial banks to do that. Are these options, through the stress tests that I know the Bank of Uganda is doing, are these options that we can be able to address this thing? I thank you.
Yes, so Gideon, so then you're talking of structural rigidities within the economy, and that while increasing competition might be helpful, so the silver bullet. And I agree with you. But then the question to you as Private Sector Foundation, the Private Sector Policy Advocacy Association in this country, is there anything you are doing or plan to do along the dimension of increasing effective competition, not just competition, but effective competition?
Of course, one of the things that we'll do is to strengthen regulation. We have all these tiers, tier 1, tier 2, 3, and all these. And we know that we have a regulator for the microfinance now. The Bank of Uganda itself is doing the regulation for the commercial banking sector. And the question again, if we are going to invite competition, is Bank of Uganda paying attention to the accumulating non-performing loans? And that is very important. If you are going to license banks here to come and establish, and even those that are here, to license them to renew their licenses again, are we asking the question, why are your non-performing loans this high? How is the loan management in this bank? How are we working with SMEs to ensure, and that's why we liked Islamic banking. How are we working with SMEs to ensure that we bring down the risk of lending? Because that is your responsibility. You're a commercial bank, but you should also be a development bank in some way. Because you have a responsibility, this economy, you're employing, it's very important for the Bank of Uganda to come out and say, look, we have licensed you to do this investment here, to do this business, but we don't want you to post 200 billion on your balance sheet, while everyone else, every time you open a paper, everyone else, a company is going under. You have a whole, like 3 or 4 pages in the new vision that are announcing business closures. People are going under. How come, amidst all this, banks have got increasing returns on asset? Why is everyone else not making as much profit, and it's only the banks that are doing so? Regulator, this is a question to you.
Gideon, just for the benefit of everyone, and if I may declare my conflict of interest on this one, it is not so much that the banks are necessarily being the only ones making a profit, because there are other institutions that are making a profit during this period. As someone once said, the best time to buy land is when there is blood on the street. But that's besides the point. I think let me turn now to Dr. Jeffries, if you can hear me. So Dr. Jeffries, still yes, the issue of competition, because yes. I find that a bit interesting twist to this whole story. You indicated that one of your policy recommendations was a way to increase competition. Rashmi, in her discussion of your paper, was asking, is perhaps increasing minimum capital or allowing for industrial consolidation one way of ensuring competition, or perhaps your intention was just say, perhaps that's just one of the many ways you can increase competition? I just for the benefit of everyone, help us understand what you had in mind, you and your co-authors, in terms of the policy recommendation with regards to increasing effective competition. Thanks.
Look, I think the point on competition is that in economics we talk about contestable markets, and what that means is that the incumbents can be challenged in a way that's meaningful. And I think if you think of the position of, say, a large bank that's got 10% market share, is it going to worry about a new small bank with 0.5% market share? No, probably not. What they're worried about is the growing medium-sized banks with 2, 3, 4, 5% market share. Those are the ones that are really going to challenge them. So, and I think this is borne out by the experience of other countries, is that large dominant banks don't get challenged by a large number of very small banks. What they get challenged by is successful medium-sized banks that can potentially become big. If you think of Kenya, for instance, what was the main source of disruption and competitive change in the Kenyan banking sector? It was not these large number of very small banks, many of which actually collapsed. It was Equity Bank. And Equity Bank sort of came from nowhere but grew and grew and grew and grew, and eventually overtook many of the big banks. So it's the, and the big banks, actually they were a bit late. They only became aware of the threat when it was too late, but they were not being challenged by these very, very many small banks. That it was the medium-sized bank and equity bank in particular that became large because it was such a successful competitor. So I think that there are many markets, not just banking. There are many markets around the world where incumbents are challenged by, if you like, the next level below them, the medium size rather than the very small size. But if I could also just make one other general comment, I think that it's important to realize that there's no single magic bullet which is an answer to this question of why are lending rates so high in Uganda. I think what our research has demonstrated is that there are many reasons, whether it be the NPLs, whether it be government bond rates, whether it be the high operating costs, and dealing with the problem of high lending rates is really going to require a multifaceted approach. It's not going to be, there's no magic wand that you can raise and solve the problem overnight. But I do think that really, from a policy point of view and even the banking system point of view, this question of overhead costs is critical. As we saw, they of the spread, overhead costs contribute about 8% of the 15%. And I was just checking the figures that I have here for Botswana, and on average, our operating costs contribute 4% of the spread, and the spread averages about 7%. So the proportion is the same. The operating costs contribute 60% of the spread, but everything is just much lower. And we have a much smaller country, there's only 2.5 million people, so we can't get the economies of scale. But I think the banks are much more efficient. They use electronic processes. They're less branch-based than they used to be. We also have a very big country with a very sparsely distributed population, and yet the banks manage to keep the overhead costs down to about 4% of a 7 or 8% spread. So I think really that's where the banks and the regulator really need to focus on bringing operational costs down through a whole mixture of different channels. Thanks.
Thank you, Jeffries. Since you're talking about costs and you've done the comparison with Botswana, where small size as it is does not enjoy the scale that perhaps the commercial banks in Uganda or some of them enjoy in terms of scale economies. And from some of the slides that were put up earlier on, it was very clear that smaller banks tend to have wider spreads than the bigger banks. And of course, like the results showed, that was overhead costs and NPLs, perhaps being one of the key drivers of this spread. I'll turn now to Everest Kayondo. You're now sitting there as someone representing the borrowers. From your perspective, perhaps from a Kasita perspective, or from the Association of Uganda Tourist Operators perspective, is it not possible that these wide spreads we see manifested throughout our banking sector, is it not possible that perhaps they reflect an unintended consequence of our actions as borrowers? That as was alluded to earlier on, much as we represent credit risk, there's a possibility we might default, government cannot default, that perhaps even in our actions in terms of how we manage or handle credit or debt is perhaps one of the reasons why the banks choose to widen that spread to kind of, how do you say, cover themselves. In other words, are we in a situation where we have a few bad borrowers who are making it difficult for the rest of us good borrowers? If I would like to include myself amongst the good borrowers. Mr. Kayondo.
Thank you very much, and thank you for inviting me for this discussion. Indeed, you are right. Part of the problem, as you have stated, the reason why this spread is so wide, partly is because of the government borrowing, where we are competing with the government. But at the same time, non-performing loans is part of the program. As long as we have non-performing loans, and indeed we have a very big challenge, because right now, even when you look at our setting in the trading sector, people who have traded fairly well, when they grow, instead of growing their trade or going for forward or backward linkages, what they do is to withdraw the resources from the trading sector, and then they invest in non-tradables. You will find somebody has been importing maybe shirts. Instead of looking at how we can bring materials and add value, we'll start maybe investing in an arcade. And now you are investing in sand and brick and cement, which is a non-tradable, and it becomes a real problem. But at the same time, the regulator, well, is lamenting with us, and I usually say that even the regulator is lamenting with us. But I think it's the policy challenge where we have the monetary policy not talking to our fiscal policy guys. The fiscal policy guys are actually, for them, it's lucky that as usual. They will continue borrowing and then invest in recurrent budgets, when actually for us at the private sector we are actually suffering. And we have tried to say, why don't you speak the same language? While Bank of Uganda might pursue a contractionary measure, but the government will continue pursuing an expansionary measure. And these are the challenges which we face. For us at the receiving end, we end up paying through the nose. And if the cost is so high, then it becomes like the problem becomes the cause of the problem. Because if I'm borrowing at a very high interest rate, and my return, because you are looking at return on investment by the bank, but even me, as the borrower, I'm also investing this money, and I must have a return on investment big enough to pay you back and even to remain with a profit or a markup so that I can move on. Because much as banks are facing other expenses, me, even the borrower, I'm also facing other expenses. Recently, where I remember, I will quote just two cases. There is a case when we had the CBR going through the roof, and we complained so much. And we said, look, seriously, you have even created a higher interest rate on already existing loans, the commercial banks. And we're asking the regulator, please, can you stop them? Because, yes, I have borrowed at a different interest rate, and when you've seen this, the CBR going up, now commercial banks were saying the excuse was CBR, and they started even rising interest rate on already existing loans. So when we complained and said, when this CBR finally goes down, are you going to go down with it, and you reflect this reduction in the CBR in your commercial, in your interest rate? They said yes. But when the reality came, again, you could see them putting up other excuses, saying, no, not only CBR is the determinant of our interest rate, we also suffer other costs. So, and recently you can see, I think very soon, Mr. Mugume will be up with it when we realize that in 2022, we are going to see a growth in the non-performing loans. Because loans have been deferred and the interest rate has been accrued. Now we have a very big burden. Our businesses are not performing. Like in the tourism sector where I am, we are locked for 7 months. And some other sectors are not yet opened, like some schools have not opened and entertainment. But these have already taken loans and they are continuing to accrue interest, despite the fact that for them they are not working. So we needed a round table talk. But for them, the banks, they are saying the regulator is so rigid, he's giving us very tough conditions, and you have to work in their what? In their regulation parameters, otherwise they will close you. So we are saying now, if Bank of Uganda seriously is aware that even for us as private sector, we are in the same economy which was closed, what are they doing to sit us with the commercial banks they are regulating and ourselves, and see how we can get an amicable solution for the entire business world? But when finally the accruals have accumulated and we start paying, because they gave up to 12 months, you will see more non-performing loans, and our collateral are going to be on the market, and then it will be like more risky to lend to the private sector, and then Mr. Hagwa will have a very big smile, because for them, commercial banks will be willing to lend to him much better than the private sector.
You present a very interesting perspective, one perhaps that we had not really considered. But, I mean, Dr. Mugume spoke about the downward stickiness of the CBR with relation to the lending rates. There is also the issue which was raised earlier on, is that one thing you're bringing about is, and also I believe Gideon spoke about it, is if we're trying to find a solution, there have to be some kind of incentives, either to reduce the overhead costs, but the overhead costs, as already been acknowledged, have some relation to do with the structure of the lending, with the kind of sectors that are lent to. And I would like to put this to Wilbrod. And perhaps also Gideon, because he represents the agency that does the policy advocacy for the private sector. What kind of incentives or incentive structure should be put in place to encourage lending to these risky businesses and consumers at an affordable rate? It was a question I believe that was also asked by Rashmi. Wilbrod.
Thank you very much. First of all, before I respond, I'm delighted. Today's discussions have been made very easy for me by Rashmi, the Kasita chair, and Gideon, who are really bringing out the real issues. That there are huge structural problems in the country, both from a fiscal point of view, that not supporting the monetary side, but real structural challenges, which have a bearing on the cost of doing business and inefficiencies we want to bring to play. And therefore, the focus of all of us here, I was about 2 weeks ago with Minister of Finance, the Finance Policy Department, and we agreed that let us not leave economic matters to politicians, the intellectuals. It is your part to play now, to point this country and its leadership to the right direction, because it's becoming clear that that's where perhaps the biggest problems lie. The question to me is, what incentives could enable us lend more? Of course, first of all, at the higher level, we need to work on the overall structural rigidities, including harmonization of policy, so that these move in the right direction, including prioritization of expenditure, like the governor said. But a combination of things need to be done. And banks, we really must diversify sources of finance so that it ceases to be just banks, bank funding. Because not every business can be funded or is supposed to be funded by banks. Because banks are lending depositors money and there's a risk premium attached to it. I was speaking to young innovators last week, and I said it may not be possible for the bank to be your source
of funding. You maybe need an innovation fund. The first thing we need to deal with is to increase the appetite for financial institutions to lend. And what is causing that? One is the discrowding by government. We can address it. But the other one is really to enhance risk management or put in place risk mitigation frameworks that encourage the financial institutions to lend more and more, including to the other sectors that perhaps they may not be doing as much now. And how do you do that? In other countries, they construct risk mitigation frameworks through guarantees. And government can play those roles in addition to other bodies, so that the financial institutions are to an extent cushioned when risk crystallizes in those particular centers. But two, when there's non-performance of a loan, the speed at which we resolve them, either through the courts of law, through arbitration, or other frameworks, are then faster. So it is not so painful to go through the process, and under prudential regulations, after a certain point, we provide fully and write off those loans, which impairs capital. So I think we should invest in all manner of systems that address risk and increase appetite. The other one that we can't run away from, and I think Rashmi speaks well to it, is increase the base. The more people we bring to the financial sector, the better, because then we are dealing with a bigger base. And three, internally, even us, and I was quick to say this at the beginning, that even us as financial institutions, perhaps there are areas we need to look at and drive efficiency by leveraging more and more shared platforms. But let me use this opportunity to comment on something about this overhead costs and so on. And I know the research generally put across aggregate figures for the industry. But within the banking system, there are different sizes of banks. The big ones, the medium, the small ones, and the composition of their balance sheet is different. So a small bank that is struggling to attract deposits may only be relying on fixed deposits, whose return is not 3 or 5%, it is 12, 14%. And it will struggle to lend otherwise, even excluding Mr. Kagwa or Finance Ministry. When the governor sent us a circular, some July, we sat as an industry with all the CEOs and literally said, how best can we respond positively to what the governor has requested us? And we went, each one, saying, for you, what can you do? And some of the member banks just said, I just can't. I have just been licensed from a micro to tier 1, and I'm using borrowed funds at this rate. I can't even bring it by 0.5%. Another one says, 60 to 65% of my deposits are fixed deposits. The moment I do that, I will be closed as a bank because I'm going to lose out capital. Okay? So some of these recommendations require looking a little bit more detail into each of the banks, and measures will differ. I like the point made by Mr. Kayondo. We have a huge challenge now. The impact of COVID and the loans we have restructured, we are restructuring, restructuring, because we are from 3 months to 6 months to 9, we are extending. But we'll go to a point and it bursts. Huge problem. Those challenges have a bearing to loan pricing in future. So I think addressing risk collectively, and it's a job for all of us, is one of the key things that would help. Thank you.
Yeah, thank you. Thank you, Wilbur. Gideon, what do you have to say about what kind of incentive structure should we be looking at establishing that would encourage lending to risky business and consumers at affordable rates?
It goes back to our determinants of the interest rates. First, as an advocacy body, really I'm looking at the business environment. Once the business environment is constraining, we have no two ways about it, but to lend at very high rates. So, and I'm in a very precarious situation because I speak for banks, but I also speak for borrowers. So the very first thing, and I think Bankers Association alluded to it, the overheads, how do we reduce the overhead? Because this will be an incentive for banks to lend at lower costs. How do we reduce the overheads that banks and everyone else, like Mr. Kayondo said, are facing? And if you look, for instance, at the cost of litigation for someone to get commercial justice, like Wilbrod said, certainly this has to be incorporated into the price of money. If it goes on for 5 years, can we make it shorter? Can we reform in the area of commercial justice? And it's possible to do that. If we look at the financial card, and I know that Rashmi here, the financial deepening sector, is attending to this. We have the national ID. We must have a financial card. Kenya has got it, and they are linking to the Credit Reference Bureau. What is it that we can do, and do it quickly, to make sure that we reduce the risk on the borrowing side, on the demand side of money? This is something that government can do within months. Why are we not doing it? That is an incentive for banks to lend at lower costs. Then 3, the appetite for money. Can government become more frugal than spendthrift? Frugality. Mr. Kayondo alluded to it. The private sector is contractionary, but the government is expansionary. You know, we tighten our belt, other people are loosening their belts. What are we doing? Now, this is what gets government into the domestic market. So if we can do that, and it's possible to do that, to limit yourself within the confines of the budget. In the private sector, if you don't have money and you go employing people, you are likely to go under, and the bank will sell you. Unfortunately, government cannot be sold. Then you have all these issues around the project analysis by banks. Let the banks themselves that are lending do some in-depth project analysis. Why would you lend to someone who is presenting to you to go and do an arcade? Do an arcade, which is not going to return money in the time that you need this money back, the loan plus the interest. And all these arcades are in town empty. No one is occupying them, but you have lent them money. Have you done sufficient project analysis? So that is also on the side of the banks. Then finally, can we do financial literacy trainings? For the borrowing public, I told you, most of the borrowers that are getting into these banks, and I'm really very happy, BOU and Bankers Association, about the aspect that now every bank has got an SME sector, SME banking. They are paying a lot of attention to that and working with them now to be able to reduce the NPLs. Can we do that a little bit more? Financial literacy trainings. I thank you.
Yes, thank you. And I just want to add on the financial literacy. In the experience of supervising banks, oftentimes borrowers, I think it's a combination. There's what I call it the triad of foolishness. In the sense that there are 3 aspects that tend to come together and then spoil it for the borrowers. There's ignorance in terms of what they're signing up for. There's desperacy for the money that they need. Okay? And then there's the reversion of funds. I believe, in my opinion, those 3, jointly or singly, or in whatever combination, do influence the kind of NPLs that we end up seeing. But that aside, let me now turn to Mr. Kagwa, before I turn to Jeffries. Mr. Kagwa, I won't call it an allegation, but Mr. Kayondo talked of a disconnect between monetary policy and fiscal policy. Fiscal policy is your baby. Monetary policy is under Dr. Mugume. So what Mr. Kayondo was saying is that when Bank of Uganda goes expansionary, that oftentimes the policy response from fiscal is
the other way around.
Is the other way around. It's in the opposite. So in other words, from using a phrase in statistics, they are negatively correlated. That one is going up, the other is coming down. And yet you see, when one is pushing up and one is pushing down, and somehow you're all supposed to be going forward, I'm not very sure that can happen. I'll give you an opportunity, Mr. Kagwa. Perhaps you help us understand if this is indeed the case. I am not saying that what Mr. Kagwa said is true or false, but your perspective on this.
Thank you. Before I get to that one, I just wanted to say yes, because I think there was a lack of clarity in what I said, and Dr. Mugume really jumped upon me, and I said, hey, what's going on here? All I was saying is that government does borrow from other banks, and it does create to crowding out the private sector. It does, and it leads to high interest rates. But I was saying that it's not all, because we are looking at why interest rates. Today, if government stops borrowing, is that going to give you the magic bullet, like we've been saying, to reduce interest rates? It may not. So we need really to understand the whole ballpark of what we call the factors that are leading to high interest rates. And yes, government is cognizant of this. You can look at the debt policy, because people will say, oh, but government is not looking at this. Some of it is being labeled reckless, but I think it's, there is a saying in Luganda which he knows very well, that atamukute yagamba yaye. When you are watching from the outside, let's say in the boxing ring, I say, why isn't this guy giving him a knockout? What is wrong with this fellow? Why isn't he scoring when it's a football match? But just because you are not a footballer there, you can only talk. So really things we really have to take hard choices sometimes in the things we do. It's not like we are reckless. There's nobody in government who is reckless. And so that is a very, very serious statement. We are rational, we are logical, there are circumstances that have forced us to do some things, and we can explain them. So let us look at it. We agree technically, yes, that we shouldn't be going on to borrow. But now getting to this issue, I don't think we are following that we are moving apart. We may, the borrowing, of course, that we do sometimes, even incremental, does not necessarily mean that we are opposing monetary policy, because monetary policy is not just one thing, the CBR rate. In all the things that Bank of Uganda does, we are working together. So we don't move in different directions. Even when we are going to borrow more, we really sit down with the bank and tell them about this urgent need and what should be done. The effect may be different, that when we borrow, it may look like we are not in sync with Bank of Uganda, but that doesn't mean we actually do not sit down together and talk, and we know that we have to follow the same path. Thank you.
Yeah, thank you, Mr. Kagwa. Now, I would like to turn to Dr. Jeffries, if he's on. In one of the findings by Dr. Jeffries was where he talked about the impact of the return on assets, which is largely driven by the high capital levels or high capitalization of banks, having an impact, being positively correlated with these interest spreads. Now, my understanding, and perhaps this is, I don't know if in this case this would apply, is that while having high capitalization levels might seem a bit either inefficient or driving the wider interest spreads, but making reference to what Mr. Governor Gideon said, in the event, for example, next year when we come out of the current credit reliefs, it is that very same high capitalization that's going to enable us to absorb the potential losses that we expect the sector to be seeing at that time. So, high capitalization, while having one potentially negative impact on the spreads, also presents, there's a cost-benefit analysis. It has a cost in terms of its impact on spreads, but it has a benefit in terms of enabling the financial sector absorb losses, but especially arising from systemic crises like what we're currently facing. So now, my question to you is, is it possible that while high capitalization, is it possible that, can you just tell us if there's supposed to be a balance in terms of what constitutes low capitalization or high capitalization? Is there something, such a thing as appropriate level of capitalization? Bearing in mind that we have...
Yeah, let me respond to that. But in part, I'm going to pass it back to you as the regulator. So, of course, when central banks determine the level of capital adequacy that the regulations impose on banks, banks will be determining those levels so as to enable the banks to withstand those shocks, which includes exceptional shocks if necessary. So I think let's assume that the regulators, which in general I must say are very good, put a lot of work and resources into calculating appropriate capital levels to enable banks to absorb those losses. And as I said very early on in my presentation, capital is extremely important as a buffer to absorb losses and to ensure the stability of the financial system. I think the thing to look at is if we see banks holding capital that's far in excess of the level determined by the regulator, that's when we have a problem. On the basis that the regulatory requirements for capital adequacy are well constructed, generally, yes, we would see banks maintaining a small margin above the regulatory capital. But the problem becomes when they maintain a large margin, and certainly that seems to have been the case in Uganda, that the margin above the regulatory minimum capital is at times has been rather high. So I think that obviously there may be losses coming, as we know, and those losses may actually cause banks to consume some of their capital to meet those losses. But once this has happened, I think it's important to make sure that banks are not incentivized, whether it be by their parents, their shareholders, or by the regulator. They shouldn't be incentivized to hold capital significantly in excess of the levels required by their regulator. Thanks. Yes.
On that, we also still have to remember that while what constitutes excess capitalization, in the Ugandan case, we have to remember that what we're seeing now is manifest from the experience, I believe it was 2011, when a significant number of banks faced a lot of distress. So I believe it might be a classic case of once bitten, twice shy. That has happened in the past. I cannot rule out it can happen again, even if the two are not necessarily correlated, and that they therefore by default hold significantly more capital. But then of course the downside is that it has then an impact on widening the spread. My follow-up question to you is, and it's something that Moses Kagwaru made reference to, where he said, look here, even if government stopped borrowing, is it likely that the interest rates or the interest spread would come down? So then perhaps, just for the benefit of everyone here, would like to know if perhaps in your empirical analysis, if you decided to control and remove the element for the ability to use the Treasury bill 364-day rate, that if you removed that from the analysis, one, would it reduce, would it significantly change your findings? In other words, that if somehow in the general discussion, the TB rate wasn't there. Because remember, you were looking at the rate a saver receives and the rate a person borrows at. If we removed and assumed there was no government borrowing, would it have significantly affected results? Did you conduct that kind of analysis? Thank you.
We didn't put that in the detailed model. In terms of we didn't put the bond rate in the model, but we did include the Treasury bill rate in the model, and that did have an impact on determining spreads. So the results of the empirical analysis suggest that if government borrowing was less significant, and therefore that would enable rates on government securities, bonds and treasury bills to come down, that would help to reduce the spread. So yes, the empirical analysis does support the hypothesis that if government borrows less and interest rates on government securities are reduced, that would reduce the spread.
Okay, thank you. Mr. Kagwa, unfortunately, you won't allow me to come back to you. There's a question we've received online, and it's largely centers around that: is government considering some other alternative forms of borrowing or financing, which were, I think, be referred to by Gideon, other than borrowing directly from commercial banks? In other words, has government considered issuing some kind of publicly listed bond or infrastructure bond or whatever it is as a forms of financing government government expenditure?
Thank you. Yeah, government is considering many options of raising resources. One of them was, of course, the domestic mobilization revenue strategy, which is supposed to bring in 0.5 percentage points of GDP increment per annum. Of course, that has been disorganized a bit by COVID-19, where business is slow. But that is one. The other one, yes, we are looking at in the debt strategy. Really, the concentration is so much on borrowing from multilateral donors at a very concessional rate for most of our projects. And we've been doing that a lot of the time. It was actually these few years, I think 2 to 3 years, where we've borrowed more from the public here. Reason, because we had urgent things to do, especially on the oil roads, because we wanted to get out the oil. So the oil projects have had a big impact on us borrowing domestically, because there have been more things. And then we suffered a huge revenue shortfall the year before last, where we needed to borrow to cushion, because we had projects that were ongoing. So without these shocks, our borrowing from the domestic market should be less. And talking about bonds, we are considering that, but it's true, of course, it will still be borrowing. But yes, we are considering, but for specific projects, yes.
Thank you. Now, this one, I'm going to turn now to Wilbrod. You know, you're also part of the group that's on spot here, especially having been a former CEO, so you have to answer these questions. In one of the slides that Rashmi put up, we were looking at the numbers of credit to the private sector using movable securities. Last time I checked, which was, I believe, was on Friday morning, I have not seen such numbers within our own sector here. I believe there are only 1 or 2 institutions, perhaps at MDI, that attempt to lend against movable securities. Now, URSB has put in place a system for the registration and the tracking of movable securities. I just need to understand, perhaps from a perspective as the banking sector, since you represent banks tier 2s and tier 3s, we have the law, we have a registry for movable securities. Why are we failing to get the banks or the tier 2s or the tier 3s signing up to this and beginning to extend credit on the basis of movable securities?
Thank you very much. Before I just respond to that, 1 or 2 things struck me in the conversation. And I said I thought I would use the chance when you asked about incentives, how can government help this situation beyond the domestic borrowing? And perhaps it will also shed light on the uptake of movable collateral securities. We have a project in the banking system now to try and link for our KYC, Know Your Customer, identity authentication. We would like to automate the process so that we are directly connected to NIRA, the National Identity and Registration Authority. We started this project last year. Until now, we have not made significant progress. And yet, identity authentication is one of the critical factors in making a decision whether to lend, to approve a transaction, whether it's a simple payment transaction or otherwise. And if it has taken that long for such a critical, important aspect, the uptake is affected by such things. Those things have a bearing eventually to uptake of other alternative collateral. Because we want to be sure, yes, you have a sewing machine or a dental chair which is movable, which you can carry and not hide away or give to your brother and run away with it after lending. But at least first we know your identity very, very well. And that doesn't seem to be getting priority, including even when this country has been put on the national grey list from a KYC point of view. So perhaps those are important things our brothers elsewhere in government should appreciate the importance of certain things to the sector. But let me come to movable collateral. It is a very welcome thing. It is one of the alternatives that just across the neighborhood, Kenya, the lending sector there heavily uses. It is good. The work that URSB has done is wonderful, including Simple, which is the tool they use, and the registration framework. I think this is going to be gradual in the uptake because, as I said, in addition to the effectiveness at the URSB level using that model, we want to be sure that even when you've used it and you have to recover, it's actually recoverable, you can get it, you can trace it. And as we continue to strengthen the identification processes and follow through, the uptake will go up. Obviously, because they are fairly smaller in size, the likelihood of its uptake will start with a smaller amount of loan value, but also because that's where the pricing is highest. So I think it's just a question of time that we will be able to have a higher uptake to the levels that we are seeing. I also just want to use this chance to say something about the shortage of long-term capital. It can also manifest into some of the challenges we are having. And I think part of the policy options that we take is to increase the variety of alternatives that provide longer-term capital, so that the challenges of mismatches that we talked about, the fears of successful businessmen shifting trade money into malls and arcades goes away. Because even malls, in a way, help. You have to buy cement. That means the manufacturer is supported. Steel, the workers who construct. So it has a multiplier effect as well on the economy. In fact, real estate is such an important sector. But for sustaining trade, obviously financing trade is important. But I think it is important that we also look at increasing long-term finance, because it supplements the alternative capital and obviously less pressure that we are feeling in the commercial banking system. Because for every little challenge of lending, it is weighted onto the banking sector. Yet I think there are alternatives that we can work on.
Yes, thank you, Wilbrod. So I can see that the time is not really on our side. So now I'm going to put out one question to all of you, and I'll give you maximum 2 minutes. I'm trying to be brief. And just give me your thoughts on it. And it's a question that kind of indirectly comes out of the recommendations and findings by Dr. Jeffries, but it's a question that Rashmi specifically put in writing. Does the current economic structure, or perhaps structure over the banking sector or the financial sector, does it encourage the assumptions of risks associated with financial intermediation in a way that would allow us to bring down or to reduce the interest spreads or bring down the cost of lending? In other words, to try and simplify it, is our banking sector, is our financial sector, is our general economy, is it structured in such a manner that it's even possible for us to find solutions? They're not also, I'm not talking about the solutions that are related to policy, but the very structure, the structural rigidities that were spoken about by Gideon. Is there something about the structure of the economy or the banking sector or the financial sector that we can take advantage of, or we can adjust or tweak to encourage banks to begin assuming some of these risks that they are necessarily or inadvertently stepping away from? I'll start with Gideon.
Moderator, I said one of the solutions is going to be to strengthen regulation of the financial sector. I know some people have said the financial sector in this country is over-regulated. But I think there is something that we need to do to fix the structural setup of the financial sector. And coming back to what Wilbrod just alluded to, the cost of money coming down is going to be largely based on the manner in which we support the provision of long-term money. That is a structural challenge, because when you look at the banking sector in this country, you only have one development bank. The rest are commercial banks. That is a structural challenge in the economy. When you mirror this against everyone else around us, Kenya, Ethiopia, and so on, you'll find it's a different setup. So how much in terms of structure can we encourage more development lending than commercial lending? And to be able to do that, it's very important for all of us Ugandans to ensure that we save more. And that's why, looking at my sister here, Rashmi, this Social Security Amendment Bill, which we are working, and I'm really very happy, we sit on the same committee, Wilbrod, the NSSF Amendment Bill, we must ensure that it comes through Parliament to encourage savings from every one of us, including the informal sector. It's very important. Once we are not able to save, we cannot invest. We always run to the commercial banks, but we always meet with 20% and so on. The only way we can get agriculture, we can get manufacturing, we can get trade and commerce, or even oil and gas, people who are going to be supplying to oil and gas. We are saying we are going to have $20 billion in the next 3 to 5 years. And the private sector must act to partake of this opportunity. And much of it is going to be leveraged on how we get financing at 8%, at 5%, at 10%. So that is a structural aspect that we need to. Then the other one, and I look to Mr. Kagwa, you borrow from the domestic public, you want to pay the private sector, the domestic areas. They have accumulated over time. And you constrain cash flows. These guys cannot go back to the bank to pay their loans because you have not paid them. That is a structural challenge in the economy. You're talking about billions of shillings locked up in the domestic areas. These SMEs who are borrowing from the different commercial banks, the reason you have all these NPLs going up, this is part of the problem. So as we talk about domestic borrowing, and I don't want to encourage domestic borrowing because we want to pay domestic areas, like borrowing from the bank to pay the insurance. This is not the way to go. We need to ensure that, because today the tax ratio is about 14.4%. The reason the government is coming to the domestic market is because they cannot mobilize money through the tax system. So the natural growth of the tax yield will largely depend on how we encourage and support the growth of a business environment that is attractive to the private sector in terms of profitability, in terms of productivity, so that they can be able to expand the capacity for the tax base. So once government is able to get more money through the tax system, possibly they will come down on borrowing from the domestic financial sector. These are some of the structural challenges that I thought we need to really pay attention to. I thank you.
Thank you, Gideon. Everest, try and keep it 2 minutes.
Yeah, I'm just worried because the appetite to overcharge is still high in Uganda for the financial institutions. I'm stepping away from the commercial banks, and now I'm looking at what would be like the mitigating factor for the small, for the very small and the micro. And we already have something at Prime Minister's office, which is called Microfinance Support Center. This Microfinance Support Center largely gets money, I think, from African Development Bank. And at what rate? 2 to 3% per annum. And when they own lend, how much they lend to the microfinance, that is the Tier 4 group, they are lending at 12%. You can also look at this one, which was, now you expect these people to lend at a lower rate when they are picking it at 12%. Again, it becomes tricky. Now, I'm not, because this one would be like this, the one which is setting an example that look at these funds, even the markup is minimal. Because if you are picking it at 2% and you are lending it at 12%, that means the markup, even from that level, is 10%. So, I am saying we need a conversation which should involve the commercial banks, the regulator, and even the government, so that at least structurally we can look at those areas and see how we can help the entire business. And because commercial banks should have also that empathy that when I'm overcharging you, then I'm even making you incapable of paying me on time. And looking at the providential funds, yes, it's good you are regulating, because it is a catch-22. We need to bring more provident funds on the market. Some have started, and others, institutional provident funds, are also working in conjunction with the National Social Security Fund, which is compulsory. But even the voluntary ones should be encouraged. So make the law to the level that provident funds are not turned into mini savings account, but actually the ones which are working for provident, and they should be long enough so that they create patient capital for those who want to get or access to long-term borrowing. Those are the structural changes which I think can help a bit. I thank you.
Thank you, Everest. Mr. Kagwa.
Thank you, moderator. Yes, I think they are, in the current structure of the banks, when we continue with these conversations, trying to tell them that there is a problem that we have identified. And the problem is the high interest rates. And this problem does not help anyone. Maybe them in the short run, but it does not help anyone, because high interest rates chase away good investors. Nobody is going to come and invest in that. So you are going to get speculators who are going to borrow at that rate, and they will have all sorts of these problems. So it's really important that this conversation gets carried on. Try and look at the banks and say, well, can't you really reduce your rates? Because what I look at is, can we get a proper decomposition of what really constitutes the interest rates? And then we can look at some of these issues and try to resolve. I know Ulbred has mentioned about the operating costs we have all been talking about. But how can we help the small banks to really alleviate this challenge of operating costs? We've been talking about it, operating costs, but what can we do with them? Is the consolidation of these small banks enough? Maybe it's not enough, but we need to really look at what are these issues. Since they are a service company, it's most likely ICT and other things. We have tried to do things, but in this study, the impact of what we have done on the operations of the banks maybe what didn't come out. Like agency banking, what has been the impact? What has been the impact, for example, of bank assurance? So these things, what has been the impact of government coming in, for example, with the ACF? So far, so much money has been poured, but what has been the experiences of commercial banks when they have partnered with government, and what has been the experience when new innovations are introduced? So we really need to take that conversation higher and try to understand. Maybe that will be a way to try and unlock this whole issue of high interest rates. Thank you.
Wilbrod.
Thank you. Yes, I think that the structural challenges that are there, and if we dealt with them, could change things quite a bit. And for me, I have about 3 or 4 areas. Beyond the policy harmonization that we have spent a lot of time, yes, there are market structural issues that need to be dealt with. First of all, there are many players in the financial sector, and commercial banks are just one of them. There are players in the pension sector, the retirement benefits, there are insurers, there are development finance, there's the capital markets authority. All these are important players, and as we look at the financial sector, let's look at all of them, because they all play a role, and each one of them is a source of funding, however, for different sectors and different timings. The second one are obviously regulatory aspects as well. I think as a regulator, you have observed a lot in the market. Even within our membership, there are differences in size. There are large ones, there are medium size, there are small ones. And the regulation may have to differ. And again, the research, when it talked about overcapitalization, we had a debate earlier. Is that really the case? Because in some of them, you find that perhaps this is not the case. But also because Bank of Uganda must have had a history why they put this level of capitalization, which we all know, especially to withstand shocks. And for that reason, in fact, there are some conversations to actually take it higher in the event that there are harder circumstances. So I think that one requires decomposing and perhaps categorizing how do we deal with large, medium, and small than a general rule applying across. But I think on the government side, and Mr. Kagwa has mentioned it, there are some success stories perhaps which we can replicate. A case in example is the ACF. Small as it is, and I call it small because it is not 1 trillion yet, but it has had success stories. If we have such a model, especially for struggling sectors, agriculture, ACF is agriculture, but take an example now, after the COVID. We have a big problem with schools who have borrowed heavily. There is no cash flow because the children are at home. Even as we restructure and capitalize the interest, like Mr. Kayondo said, the challenge is still there. At such a time, that's where a fund, either an education fund or something, which is longer term in nature, and government can get various cheaper sources from outside, guarantee them, and make this available to cushion schools or cushion the financial sector. The shock the financial sector is likely to get because of stress in this particular sector. Such sector interventions help cushion through a tough time, but also in the long term, help to build that necessary infrastructure. So I think sector-specific interventions, especially led by government, will be critical to address some of the structural issues. And so I agree with you that those particular changes in that area would help the situation.
Thank you, Wilbrod. I'll also ask Dr. Jeffries. For him, it's kind of unique, is that he has been the deputy governor, so he's handled monetary policy. He is now an advisor in the Ministry of Finance in Botswana, so now he's moved to fiscal policy. He has had the opportunity of going through our numbers. Jeffries, from your assessment, and this is not binding on you, so I don't intend to take your opinion to the bank to get a loan. But from your assessment and your opinion, do you think that the current structure, be it of the banking sector that you focused on, or what you think you've seen the banking sector that gives you an idea about the rest of the financial sector, do you think that there is anything in the existing structure that you saw that encourages the assumption of risks that are necessary to grow financial intermediation?
I think that the attitude towards risk and the management of risk still has a long way to go. I mean, it's partly because government, as we've discussed, offers these very attractive rates on risk-free assets. So that in itself discourages the banks from assuming risk. And as one of the commented very acceptably, that if you've got that risk-free benchmark rate and the commercial banks then have to lend at rates higher than that, all they're going to get is high-risk borrowers, which does not help. Well, I think there's a clear back. Sorry about that. We had a connectivity problem. Not sure where it was. Yeah, clearly there's a crowding out of the low risk borrowers. But I think these various things that have been mentioned, improving the credit registries to ID, speeding up legal processes, the movable collateral registry. These are all bit by bit ways of improving the ability to deal with risk. And if we get to the point where government borrowing is reduced so to reduce the free rate, then I think banks will then potential borrowers on the basis of proper risk assessment. But it's
thank you, Dr. Jeffries, except that unfortunately we lost you along the way. So, ladies and gentlemen, I'm going to try and see if I can find a way of wrapping this up. We've had a presentation as to what the drivers, the drivers for interest spreads are in this country. We've had a set of panelists here who have given us their perspective on various aspects of some of those drivers of the spread of the interest spreads. We have had a discussant who also came and tried to put everything together and basically reiterated some of the recommendations that came up from the findings of this research. And I'm going to try and decompose them into about 6 or 7 elements. One in terms of policy recommendations going for things that can be considered and looked at, is the introduction of some kind of risk-sharing model within the financial sector. Now, it can be risk-sharing between government and the commercial banks. It can be between the commercial banks and commercial banks, in which case the use of derivatives or the development of some kind of derivatives or hedging market. It can be between the commercial banks and insurance companies, who tend to have better experience in estimating the likelihood of events happening and therefore the losses associated with such events. There is a recommendation around effective competition. We don't have quite agreement in terms of how the best way to achieve that effective competition is, but everyone seems to agree some element of competition is needed. When you see that, when you look at the kind of concentration, computer concentration ratio or the Huffington index, you'll find that about the top five banks account for more than 65% of all loans and assets in the sector. That kind of concentration means they are a quasi-oligopoly, which has its own welfare implications to society's welfare. There's the issue of capitalization. There's the issue of capitalization that was raised in the research. Now the question then becomes, how do you balance the amount of capitalization that the bank should have? Is there such a thing as too much if our past experience demonstrates that we've been subjected to significant crises and the only reason we went through was that we were holding adequate amounts of capital? There's been a recommendation around information asymmetry, which I've summarized around information asymmetry, the use of IDs, the identification and authentication of identity prior to concluding or commencing transactions. And then there's a recommendation which is largely to my friend Moses Kagwa. While I will not say that government should stop borrowing, I think the recommendation is largely that government should focus the majority of its borrowing on financing revenue-generating projects. Broadly, I want the details are up to you, your Director of Economic Affairs. And also, lastly, for the Minister of Finance, is that, and I'm aware your finance is planning some kind of integrated financing strategy. So, of course, we don't want the details, but one of the recommendations was that to reduce the impact of government borrowing, because government borrowing will always have to happen, but to reduce the impact on private sector credit growth, government of Uganda needs to begin considering alternative financing models for its expenditure. So, ladies and gentlemen, the organizers, the panelists, those who have attended physically, those who have attended online, I would like to thank you very much for being a wonderful audience. There are those who sent in questions which perhaps we've not gotten to, but we will let you know that those questions will inform any of the policy decisions and actions that come out of this session. The panelists, Mr. Wilbur Awar, Mr. Moses Kagwa, Everest Kayondo, Gideon Badagawa, the discussant, Rashmi Pillai, Dr. Jeffries, Keith Jeffries, and Dr. Mugume, who ably represented Bank of Uganda, both in his capacity as the Executive Director of Research and as acting today as the Governor. Thank you very much, and thank you for your attendance.
Thank you very much, Dr. Twine. I want to thank everyone that is here. First, our main speaker, the panelists, the discussant, and even you, the moderator. You didn't thank yourself. Thank you. To our many participants, the virtual participants on social media channels and TV, many TVs, I want to thank you very much. We have received your questions and comments, and I will encourage you to keep sending them in. A team from the Bank of Uganda will look at them and respond by Twitter and Facebook as and when they come. So please keep them coming in. And as we close, Gideon in particular reminded me when he said that what is it that you can do? UBA, Ministry of Finance, the regulator, what is it that you can do? And he said, do it quickly. He reminded me the story of Jesus when he was telling Judas that what you're about to do it quickly. So MOFPED, be more frugal. Everest and your team, the borrowers, please be more literate financially. UBA, you've heard the cry of everyone. Bank of Uganda, the regulator, you've been accused by Everest of lamenting together with the borrowers and having monetary policy, not speaking to fiscal policy. What you're about to do or should do it quickly. Ladies and gentlemen, we've come to the end. Lunch is ready, and it will be in Addis Hall. Addis Hall is down the corridor and to the left, just before the stairs. It is free seating. Our panelists shall be led by the hotel staff, the panelists, the moderator and discussant, and then the rest of us shall follow. It's free seating. However, if you feel that the social distancing isn't as good as you want it, you can still carry your plate and bring it back to where you're seated. We've come to the very end. Ladies and gentlemen, I thank you. Come again. God bless you all.